Let's talk more about metals now. I'm joined by Robert Cohen. He's a portfolio manager at Goodman Co, where he oversees the dynamic gold and precious metals fund. That fund's up 77% in the past year. It ranks in the 98th percentile among its peers. And Robert's joining us. He happens to be in town from Toronto, and he's joining us here in studio today. We've seen gold really going back and forth quite a bit today. Talk to me a little bit generally about your gold outlook, given the concerns about Greece and some of the other concerns about global economies.
Sure. And one of the main drivers of gold is the amount of gold out there versus the amount of money supply out there. So if you're looking at drivers of the gold price, you're looking at, for example, monetary and fiscal reflation. So every time we have a crisis in the world, whether it be the big financial crisis we had here in late 2008 and also the Greek financial crisis, whenever there's a resolution to this crisis, it often involves the expansion of money supply. And there's a very tight correlation between global liquidity and the gold price.
So how much longer do you think we're going to see these increases in gold? I mean, we talked to one stock investor today, John Dorfman, who's a Bloomberg contributor. He thinks this is a temporary situation in terms of the concerns around Greece and the remedies as well.
Well, every time there's a financial crisis and there's a remedy, it's always the remedy that's good for gold. A lot of people confuse the crisis itself as being good for gold. It's actually the remedies that are good for gold. However, you know, it's a question of what are the reasons we're going to see monetary expansion over the future. So short term, we've seen a lot of financial crises. I don't think the Greece one is the last one we'll see. And then more on the long term, we'll still see not only fiscal budget deficits in most of the developed nations of the world going out as far as the eye can see. And again, governments tend to print their way out of these problems. And then ultimately, we have a problem with the developed countries of the world with very low birth rates. So every day, there's a larger and larger proportion of the population is in their retirement years versus working class years, and ultimately those debt burdens that are involved with healthcare costs, pension care costs of the growing retirement class is proportioned onto a smaller and smaller portion of the working class.
Well,
so again,
Robert, all of these fundamentals may be true, but at the same time, we're looking for almost an unprecedented bull market in gold. We've seen annual gains for the past 10 years. That hasn't happened since the 1920s. So how much longer can that kind of run go?
Well, these type of runs can run multi-decades. So while we are 10 years into the bull market, if it were to end today, for example, it would actually be the shortest bull market for gold. So we can see this go for several decades. You know, it took, if you really look at the financial crisis that we went through in 2008, a lot of the beginnings of it developed back into the late 1980s. It took about 20-25 years to develop the mess. It doesn't get solved in 1 or 2 years.
I quickly want to get to some of your picks because we haven't had a chance to get there yet. There are 3 Canadian mining companies, Osisko, Redback, and San Gold. And they've done very well, obviously, although gold stocks generally have not necessarily paced the rise in gold itself. So what makes these 3 stocks different?
Well, a lot of companies, besides getting a leverage to the gold price, a good mining company that is finding other sources of upside, alpha, despite the gold price. So if you were finding gold and developing the newest and largest deposits that as they're being discovered, the market rewards you for that. And whether the gold price is $1,100 or $1,200 or $1,500 an ounce, or even $1,000 an ounce, they are creating a lot of shareholder value independent of the gold price.